Hi everyone, my name is Mark Quinn. I'm a UK qualified tax advisor and chartered financial planner, and I help clients who are looking to relocate to or who are currently living in Portugal manage their tax and financial affairs. And in this video and subsequent videos, I'm going to look at key investment options for Portuguese tax residents. And the focus of today's video is going to be looking at what's called QNUPS, so qualifying non-UK pension schemes. And in future videos, we're going to compare and contrast QNUPS versus Portuguese compliant investment bonds and also direct collective investments. So what is a QNUPS? Well, QNUPS stands for Qualifying Non-UK Pension Scheme. Now, it's not to be confused with QROPS. So a QROPS stands for Qualifying Recognised Overseas Pension Schemes, and it can be a bit confusing, but a QNUPS is generally formed with your own money. So if you have cash to invest, or indeed if you have assets that you're looking to put into a QNUPS, then you can do so. Whereas a QROPS is actually a form of pension scheme that only receives money from another recognised pension scheme. So if you had a UK pension scheme, for example, a personal pension plan or a self-invested personal pension plan, then you can transfer that across to a QROPS, which is basically a pension scheme, an international pension scheme that's been recognised by HMRC in the UK as kind of a bona fide equivalent to a UK pension scheme. Actually, although a QNUPS is a form of international pension plan, it's not a scheme itself or a structure itself. It's actually a tax status deriving from inheritance tax legislation, which dates back to 2010. And that actually gives a clue as to the main benefits of using the QNUP scheme. And we'll cover that a bit later, although that particular benefit of using a QNUPS has been changed by the introduction of the new pension rules as announced in October 2024's budget. And again, we'll cover those changes a bit later. So if we think about forms of pension schemes from a UK context, the main benefit, or one of the main benefits of using a tax relief pension scheme is that when you put money into the pension scheme, you get an additional amount added to your pension in the form of tax relief payments. Now, a QNUPS doesn't actually benefit from the tax relief status. So if you put £100 into a QNUPS, the actual gross contribution will be £100. You're not going to get any extra added by the government. However, you can put more money into a QNUPS than a tax-relieved pension scheme would allow. So if you're still contributing to a pension scheme in the UK, you have a maximum annual allowance of £60,000 per UK tax year, or 100% of your annual, what we call relevant earnings, so your annual income. So QNUPs have historically been used for people that have hit those upper ceilings on what they can contribute to their tax relief pension schemes, but they want to allocate more to their retirement savings pots, and a QNUPS is basically a top-up form of scheme for that purpose. When you're putting money into the QNUPS, it can be in the form of cash, which is obviously the most simple way of getting money into the scheme, but you can also transfer assets into the scheme. And one of the benefits of QNUPS is it has quite a lot of flexibility in terms of the investment choice you can hold within the structure. Just bear in mind that when you're actually putting cash into the scheme, there's no tax complications in doing so. If you're transferring assets into a QNUPS, you may also have to consider the tax implications of that transfer of ownership. So, for example, transferring a property into a QNUPS scheme may trigger a capital gains tax charge. So you need to be aware of the nuances of doing. In terms of taking money out of a QNUPS really has to broadly conform with pension scheme rules, which means that at some point an income is going to have to be taken from the structure. When you take that income, you're taxed as you would be taking any other form of pension income. Now, if you're a Portuguese tax resident, and you have non-habitual residence status, then if you got your NHR status prior to April 2020, then in theory it will be tax-free because the pension tax rates applying for those NHRs was 0. For those of you that got NHR after April 2020, a 10% flat rate of tax applies to any money taken out of a QNUPS. The interpretation of income taken from a QNUPS, and any pension scheme for that matter, gets interesting when you consider how Portugal looks at pension schemes. So they have different ways of reporting income, and it can be 3 forms of interpretation. The first is it can be added to your normal scale rates of tax. So this is the income tax bandings that we're used to in the UK, where the more you earn, the higher the tax rate goes. So that's one form of interpretation. The second form is that it could be treated as investment income in certain situations. And the third is what's called the 85-15 treatment. So when you're taking money out of a pension, in certain situations, you can declare 85% as a return of your tax-free capital, and only 15% is declared as a taxable element of that withdrawal. One of the issues on the income tax position of QNUPS is that you can be turning capital into taxable income. And by that I mean, if you started a QNUPS scheme, say with £100,000, and then you start taking income from it, even if there's been no growth in the fund, you're immediately taxed on the income. So you're basically turning capital into taxable income. If we contrast that with the Portuguese investment bond, for example, you only ever pay tax on the growth element of any withdrawal. So it's just something to be cognizant of in comparing the different investment options. In terms of the ongoing taxation of the QNUPS scheme, this is also very good in the sense that all income and gains within the QNUPS fund is free of tax. The only exceptions to that are, for example, if you had UK source income on assets within the fund, in which case there may be UK tax to pay as well. So just be careful about what assets are held within the QNUPS fund. In terms of investment flexibility, again, QNUPS schemes tick a lot of boxes because it's very flexible. You can hold a wide variety of investments, from cash to stocks, bonds, funds, and even some cases property. So UK property can be held within the QROPS structure. So it is very flexible, but again, please be aware of the nuances of holding these different assets and the tax implications of doing so. One of the key benefits of using QNUPS historically has been the inheritance tax benefits they had the ability to provide. Now, I stress that they had to be structured correctly at outset in terms of the amount that went into the QNUPS scheme relative to the amount of the client's overall wealth, income levels, underlying investments, etc. All these had to be well thought out and planned for correctly. But if that was the case, there was the potential for the QNUPS fund to be outside the scope of inheritance tax. So that was a 40% tax saving on any money held within the QNUPS scheme, which obviously was a big benefit for those of you who have what we call the UK domicile of origin. So if you originate from the UK, or in fact you're deemed UK domicile, you have this liability to UK inheritance tax on your worldwide assets. So the ability to carve out part of your estate into one of these QNUPS structures and potentially save 40% tax was a massive benefit. Now, some of you may have observed in the October 2024 budget, where Rachel Reeves announced that from April 2027, all pension schemes now are going to be brought in the scope of inheritance tax. So that big benefit of using QNUPS schemes from April 2027 has now been removed, unfortunately. The other point in relation to inheritance tax also derives from October 2024's budget, because there was a fundamental change announced in how inheritance tax is going to be determined going forward. and this relates back to QNUPS. So what the Chancellor announced was, from April 2025, the domicile basis of determining inheritance tax in the UK is going to be scrapped and replaced by a pure residency system. So whilst in the past it was very difficult to escape UK inheritance tax, and that's why people use QNUPS a lot to try and carve out part of their estate that would be outside the scope of the IHT tax charge. Going forward, it's going to be much easier to shed your UK IHT liability because it's going to be based purely on residency. So once you've been outside the UK for 10 years, you don't have any liability to UK inheritance tax. The only exception being any assets left in the UK will always be subject to the IHT tax charge. So again, QNUPs have kind of lost their benefit in this respect because after 10 years of non-UK residency, so once you become what's called a non-long-term resident, all your non-UK assets are now going to be outside the scope of the IHT tax charge. So in summary, QNUP schemes have a number of benefits. They have the ability to have what's called gross roll-up, so a fund where you're not paying income tax or capital gains tax on an ongoing basis. They're flexible in terms of the underlying investment options available within the structure, and in certain situations, particularly those of you that have non-habitual resident status, they can be income tax effective. However, there are drawbacks to the use of using QNUPs. The first notable one is that they have now lost their IHT effectiveness because from April 2027 they're now going to be brought in the scope of the UK inheritance tax charge. And finally, they have the negative feature of turning capital into taxable income, even though you may not have enjoyed any growth in your fund within the QNUP scheme. So the next video is going to be looking at Portuguese compliant bonds in a bit more detail and how they can compare and contrast with QNUP schemes and if they may be a better solution for you. So I hope you found this video useful. If you wanted to discuss your investment choices and options as a Portuguese tax resident, whether you have NHR or not, please let me know.